for years, companies have just been gobbling it up.
Yeah.
And I understand Mike's point about how profits and debt levels are about in flux, but profits can go down.
Yes.
Are you worried about debt levels right now, Peter?
Well, I am. And in particular, I think Mike's piece was great. There are two ways to think about that, as you know, Brian. There's the stock level and the flow level. So stock levels of debt are high. That is debt to EBITDA, for example. But interest coverage, which is the amount of cash flow generated to service that interest expense, is actually looking pretty good. It's pretty healthy. And the reason for that is precisely because interest rates are so low and have been managed so low by central banks. Now, the markets are obviously helping the sovereign rate markets right now because the worry of recession is keeping rates lower still, likely forcing the Fed to cut. But what's interesting about that, there's a bit of a conundrum there. Rates stay low, companies continue to borrow, which to me actually sort of tightens the rubber band all the more given how high debt levels are. So a recession to me is a 2020 risk. And given the level of debt, especially corporate debt in the loan market in particular, I am a bit concerned.
Will that force the Fed to keep rates low for a long time?
Yeah, I think that's the trajectory that the world is on right now. And
they literally can't do it because they can't risk a bunch of blow-ups on a lot of this debt, which, by the way, much of it is either junk or close to junk.
Yeah, and again, in the loan market in particular, and I keep referencing it, leverage is very high. The guidance had been for 6 times deals in the leveraged loan market, and those deals on average are being done much closer to 8 times now. The size of the market has grown considerably. It's about $1 trillion. The loan market overall is about $2 trillion. That's all of commercial and industrial lending. And that doesn't include the shadow banking sector, which is BDCs and other forms of corporate debt that aren't really measured by that. So the loan market is very large. And to me, that's really where my biggest concern lies.
Corporate debt levels on many different variables, percentage of this, percentage of that, are higher now than they were pre-financial crisis. But rates are lower.
Yes.
And cash flows are up.
Yes.
So do we need to worry about these, pre-Lehman references?
Well, we tend towards hyperbole at times when trying to make a point. But I think if one believes that there are still economic cycles, which I'm a believer of, I think there are natural ebbs and flows, notwithstanding what central banks do. Then I think we do need to be concerned about debt levels, and especially at the corporate level. It's particularly important. And by the way, lending standards have begun to tighten somewhat, which shows you that banks are becoming a little bit more concerned about the ability of borrowers on margin to borrow even more.
And our viewers may not care about corporate debt, but they might care about stocks. And one theme that we've been talking about a lot lately on this program anyway is companies are selling debt to buy back equity. The pool of available stock just continues to shrink.
Yes.
That's a bull case for equities.
It is a bull case for equities as long
Whether it's a fundamentally good bull case, I don't know. But if people are chasing a smaller pool of assets, those assets tend to go up in price.
Well, those buybacks, as you mentioned, are fueled by debt, by the credit markets. And so that bull case is intact, I think, as long as the credit markets are functioning correctly. But I also think it is a bit of a secular trend. That pool has been shrinking now for about 15 or 20 years. So I agree with you. That is certainly a bull case for stocks, notwithstanding the economic cycles that I think we are going to see no matter what happens.